Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of High-Tech Pipes, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Singh from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Good evening, everyone. On behalf of PhillipCapital, I welcome you all on High-Tech Pipes Q1 FY23 earnings call. Today we have with us from the management side Mr. Anish Bansal, Full-Time Director, and Mr. R.N. Malu, Chief Financial Officer. Without taking any much time, I would hand over the call to Mr. Anish Bansal for his opening remark, and then we will follow up with any Q&A. Over to you, sir.
Good evening and welcome everyone for our Q1 FY23 earnings conference call. I am joined on the call by Mr. R.N. Malu, Group CFO of the company. I hope everyone has had a chance to go through our result and updated investor presentation uploaded on the exchange. During this quarter, the company is able to register a 35% year-on-year growth in the sales and 14% volume growth. This is mainly due to better capacity utilization and higher sales utilization. However, the profitability of the quarter impacted due to high price differential between pipes manufactured from primary coils and secondary coils. Also, one of the main reasons, the reduction in steel prices due to the imposition of export duty on hot-rolled coils on 22nd May 2022 by the Government of India, as well as the downtrend in international prices of HR coils resulted into channel destocking and consequently also impacted our margins. We found the impact of steel price correction as short-term and confident that this will definitely help in increasing our volumes in medium to long term. Now, I would like to take you through the ongoing projects and other developments. The pipe mill upgradation project at Secunderabad for production of solar torque tubes, which is completed recently and it's working well. These tubes are well accepted in the market and we are scaling up the production. Secondly, setting up of color-coated sheet facility of 50,000 tons per annum is at final stages of commissioning at our Secunderabad plant. This is a forward integration to our existing cold rolling and continuous galvanizing line facility. This shall also increase the overall capacity utilization of existing facilities and increasing the share of value-added products. The color-coated sheets are used for roofing, wall cladding, white goods, domestic and industrial sheds, infrastructure, bus bodies, metros, railway stations, door and window frames, etc. Thirdly, the commissioning of large diameter pipe project of 60,000 tons per annum at Sanand, Gujarat facility is mainly cater demand arising from water, city gas, oil distribution and construction sectors. The commissioning of the project is on full swing and trial production is expected in Q3 FY23. We are also committed and focused to actively improve our capacity utilization of our existing facilities and also increase the proportion of value-added products. The recent decrease in raw material prices and the narrowed gap of primary steel versus secondary steel has resulted in increasing the volumes. The channel partners and dealers and distributors were earlier destocking the tubes and pipes, which are again now buying material to build up their inventories. We are continuously getting orders from the Jal Jeevan Mission and other infrastructure projects like high-speed railways, metros, telecom, etc. Government capex in energy, housing, infrastructure, railways, airports, agriculture, telecom and irrigation in the next 4 to 5 years would surely be the big demand drivers for steel tubes and pipes. Moreover, on private capex side, sectors like automotive, capital goods, consumer durables, and envisaging big capex in coming years, which would further drive demand for our steel products. So to sum it up, we at High-Tech remain very positive on India's structural growth going ahead. These developments are setting a stage for robust second half performance. I will now hand over the call to Mr. Arun Malu, our Executive Director and Group CFO, to take you through the unaudited financial results of QY FY23. Over to you.
Good evening, everyone. I will take you through the financial results of Q1 FY23. Our revenue from operations for the quarter grew by 35% year-on-year basis to rupees 517 crores, as against rupees 383 crores in Q1 FY22. The revenue growth was primarily driven by significant increase in our sales volume with higher realization. The revenue growth was primarily driven by significant increase in our sales volume. Our total sales volume stood at 0.70 lakh metric tons, which is higher by 14% year-on-year basis. Sales realizations improved by 18% to 73,673 per metric ton in Q1 FY22. Our EBITDA for the quarter declined by 14% year-on-year basis to rupees 18.4 crores as against 21.4 crores in Q1 FY22. The EBITDA per ton for the quarter stands at rupees 2,545 rupees per metric ton as against 3,467 rupees per metric ton in last quarter. The profitability is impacted mainly because of decrease in raw material prices as stated by Anisar. Our PAT declined by 50% to 4.48 crores as against rupees 8.89 crores in Q1 FY22. The decline in margin is due to higher price differential from pipe produced from secondary steel and sharp reduction leading to channel destocking. With this, we would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Hello, am I audible?
Yes, sir.
Yes,
Yes.
Vikas.
Yeah, sir, I just want you to give some guidelines on the kind of the volume target we want to achieve and reason why we are running at a so low capacity utilization, if you can.
So because our capacity utilization in Q4 was around 65 to 66%, which has fallen to 50% in Q1. This was mainly due to the destocking by the dealers and distributors. This was witnessed all across the industry. As we have seen, as the export duty got implemented on 22nd of May, that led to a strong knee-jerk reaction, and coupled with the declining steel prices, especially from the Russian steel producers, they were dumping steel for the first 2 to 3 months because of the foreign exchange prices. So these the two events they led to extreme pessimism in the market, which led to destocking. And but now we are very confident that the prices have come to quite reasonable and affordable levels. The gap between the secondary producer and primary producers, that has narrowed down significantly, which will help the company to increase the utilization in Q2 and Q3, Q4 onwards. And along with this, I would also like to point out that historically, the H2 consists of almost 60% of our volumes, and H1 is 40%. due to several factors and monsoon. So H2 should be significantly quite good because our color-coated facility that will also come into commercial production, which will eventually lead to the better capacity utilization of our cold rolling complex at Secunderabad. So all in all, despite Q1, despite the challenges of Q1, we are hopeful of maintaining 15 to 20% volume growth for this financial year, at least. Hello.
So just give me a minute. Mr. Singh got disconnected. I'm just reconnecting him.
Hello.
Yes.
Sorry, sir, I got disconnected. So I heard till the Patra gap between the Patra and the primary, which was narrowed down.
Yeah, so this was narrowed down, and the prices have come to the reasonable and affordable levels, and all the projects which were earlier stuck up, the government projects and which was stuck up because of the high steel prices, that demand is coming back to the market. And historically also, our H2 consists of 60% of the total annual volumes, and H1 is relatively lesser. So having said that, we are still confident of maintaining a 15 to 20% volume growth for this financial year.
Understood, sir. And sir, what kind of volume loss we have suffered because of this stocking? Otherwise, what kind of additional volumes
for this quarter, 15,000 tons.
So otherwise, it would have been 86,000 tons kind of the volume.
Yes.
Effectively.
Yeah.
And so my second question pertains to our value addition. Like one of your competitor, APL Apollo, they have a lot of value addition thing which is going on, which also allows them to increase their blended margins. So just wanted to understand where are we in terms of our overall value addition perspective, and where do we see to ourselves in next 2 to 3 years?
So because right now our in our product basket, the total mix of value-added products is 25% at this moment, and with the implementation of our large diameter pipes, the color-coated facility, and we are also enhancing some galvanizing capacity at Secunderabad. So all in all, we'll be going to a 30% share this financial year, which will eventually go up to 50% in next 2 financial years.
Understood, sir. And sir, in terms of our major competition, how confident we are in, because you and APL Apollo both are basically, operates in the same kind of the business as well as in the same geographies. So in terms of growth wise, how confident we are taking over this kind of the growth? Are this growth is coming from the market side improving, or we are also taking share from the smaller players which are unorganized?
So because it's a mix of all these things, but with the growth also, we are also constantly facing challenges from the external factors, like this duty, the reduction of international steel prices, and in some quarters we have faced the lockdown challenges. So all in all, the situation is quite challenging, but even then, we are hopeful of maintaining a good volume growth.
Understood, sir. And sir, just lastly, our margins are nearly half of that of our nearest competitor. So what are the steps we are taking in order to improve this margin? Or how do you see that would be our peak kind of the margins going forward?
So right now, in last 4 years, we have set up the base capacities and all the plants. Now the step is towards value addition. So we are progressing in that direction, and we are adding the coating facilities, the SKUs which help us in getting higher EBITDA per ton. So, a lot of work is going on in all these areas, and we are, focused in, in increasing our EBITDA per ton. So, this Q1 was extraordinary quarter in which, we saw a price correction to the tune of almost, 12 to 13,000 rupees per ton, which is historic. And just in a span of 1.5 months, such a steep fall is historic. So, now the markets have stabilized, and we feel the much correction has already taken place. I think another 3 to 4 rupees is all that is left in terms of steel price correction. After this, once the prices get settled here, the demand will come back in full in a full fashion.
So, any EBITDA per ton guidance which you would like to give?
We would like to maintain our, the previous year's EBITDA per ton.
Yeah, target.
That's our target. Despite the Q1 challenge.
And then any words on our capex plan? Though I know that our capacities are much higher. So this year, what kind of capex we are doing, and up to what capacity once we get to utilize, let's say, 60, 70, or 80%, then our next phase of capex cycle would start?
So our major capex has already been done for color coating and large diameter pipe at Sanand. And it is only about utilizing the same. So both the production are expected in Q3. So once these get streamlined, then surely it will definitely improve the top line and bottom line of the company.
Understood, sir. Operator, are there any questions from the participant side?
So as of now, no questions. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Ronald Sioni from Sharekhan. Please go ahead.
Good evening, sir. Just a few questions. So first was on the compressed operational profitability. So now, post Q1, how have you seen, in terms of operational profitability? Has it improved to a larger extent, or still operational profitability remains under pressure till date post Q1?
Yes, Mr. Ronald.
Yes, sir.
As we explained that mainly the compressed profitability is a result of decrease in the prices and the higher price difference from the pipes manufactured, from the recycled steel, that is the patra pipes. So these two factors has affected our profitability. Otherwise, on operational front, whether it is manpower or it is the power or it is the other manufacturing expenses, we have been very, very cautious, and we have become comparatively efficient in that part. I think I answered your question.
Yes. Post Q1, it has improved. You mean to say during July and August till date, there has been some improvement. Is what I understand.
We have seen we have witnessed a higher demand for about 10-15% in the month of July and August.
Okay.
As compared to the last quarter, there are a lot of inquiries in the market. In fact, the lifting under the government schemes, where we supply the goods to EPC contractors, there also we have witnessed the lifting.
Okay.
And if we see that the complete pipelines are vacant at this moment, once the market is confident about that there is not going to be further price reduction, and we hope that the stability will come in 10-15 days, so lifting will improve. All these pipelines has to be filled up.
Okay. So in terms of restocking, at the end of Q1, how was the channel inventory, like in terms of days or months, if you can share that, before or at the end of Q4, how was it, and at the end of Q1, how was the channel inventory in terms of days?
Inventory of the channel partners, it is not like auto industry. It is not monitored by us. But the rough estimate is that maybe if someone was maintaining 1,000 metric tons, they have reduced it to the level of bare minimum level of say 500 to 600 metric tons. Those sort of reductions has happened. So we can say some 30-40% reduction has happened in the inventory of the channel partners.
Oh, okay. And if you can also take us in terms of gross debt numbers and how do you plan to reduce debt, and also on the working capital side.
Our gross debt is more or less at the same level which was there on the last financial year. So it's around 380 crores.
And in terms of working capital, have you seen any stretch in debtor inventories or payable days? How is the working capital cycle at the end of the year?
Yes, there is a good part on this level that we have further able to reduce 3 days working capital, and that is basically on account of debtors. On combined basis, 3 days reduction is there.
Okay, yeah, that is from my side. Thank you very much, sir, and best of luck.
Thank you, Ronald.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Vaibhav Kapoor, an individual investor. Please go ahead.
Yeah. Good evening, sir. I just wanted to know that at what capacity utilization do you envisage the next line of capex to begin? Do you have some kind of a capacity utilization number in mind, or would you look at it as and when?
Vaibhav?
Yeah.
Vaibhav, as a policy matter and in the earlier calls also, as well as in the industry, once we reach a capacity utilization of about 70%, we start thinking of expanding our capacities. Here the benefit with us is that this LDP pipe project, we have taken land more than two times. This is higher than our actual requirement. So first of all, any capex we are thinking once we reach to a level of 70%. And second thing is that whatever capex will be happening, it will be a marginal cost for us. Means only cost of building and plant and machinery. Infrastructure is already existing at all the plants.
And the other thing is, I just wanted to, if you could give some color in terms of numbers of, how this, the secondary, the Patra market, what was it, in the, previously, and what is the current situation now in terms of the price differential? If you could give some color there.
Yeah. Hi, Vaibhav. Anish this side. So, Vaibhav, in the month of March and April, the spread between the Patra pipes and our organized sector steel pipes was in excess of 15,000 rupees per ton.
Right.
And right now, in the current month, it is around 2,000 to 3,000 rupees per ton, which historically, has been prevailing for many years. So the excess differential that has all gone away, which has given a major boost to our industry.
That's nice to hear. That answers all my questions. Thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. Participants to ask a question may press star and one. The next question is from the line of Hetal Gada from ITI Mutual Funds. Please go ahead.
Hi, good evening. Sir, I just wanted to understand, like you mentioned that there is a gap between Patra prices and primary HRC prices. So at what gap or how much should it narrow down? Then people will start considering again the HRC prices or the HRC way of manufacturing.
Yes,
Hello,
Ethel.
can you hear me?
Ethel,
Can you hear me?
Yes, yes. I would like to explain you that first of all, there is a quality difference. See, this is the secondary steel and primary steel. There is a quality difference. But what happens that in EPC projects or in some rural areas, these goods are used. Reasonably, the difference if it is in the range of 4,000, 5,000 rupees, 4,000 rupees around, is okay from market side. Persons started to understand the quality difference. And the quality of the pipe which we manufacture is not less than 25, 30 years, whereas in that case, it is about 15 to 20 years. Second thing is that it consumes more color, more paint. So 4,005 is a reasonable difference. And now we have reached to that level, it will definitely be increasing our volumes.
Okay. So at least at these levels, you will see that volumes will go back to primary side.
Yes.
Okay.
Our pipe industry,
yeah.
the branded pipe manufacturers growth has been 15 to 20% in industry whenever the price difference has been reasonable from Patra pipes. So that time is coming, that time has in fact come, and we will see that sort of a growth.
Okay, and that you can see already in your orders and your volume ramp up also.
Yes.
Okay. So secondly, I also wanted to understand, so your capacity has been expanding and your volumes have been ramping up. APL Apollo, your competitor keeps mentioning, because of the sheer size that they have, they usually get discounts or rebates in the manufacture or procuring their raw materials. So, are you also getting any benefit of that kind from your suppliers?
Yeah. Good evening, Hazel. So regarding the procurement and the pricing of raw materials, we are confident that our raw material pricing is quite competitive and one of the lowest in the industry, considering the volumes and the relationships that we are having with all the mills for last many decades.
So, to what extent, can you just quantify if it's possible?
I can't quantify this because, I wouldn't have there, but in the market, as per the market and what we have, what the feedback we have from other suppliers, the pricing is quite, for our competitors and for us, it is quite reasonable.
Okay, sir. And sir, regarding your plant that you have commissioned at Mumbai, what is your, how much has it ramped up and what are your plans for that? And in future, what kind of, expansions are you planning in India? Will there be more of brownfield expansions or are you planning to look for a greenfield as well?
So Mumbai operations from Q2 onwards, we are targeting 65 to 70% utilization from that plant for the remaining 3 quarters. And regarding expansion, we are first focused towards achieving our 70% utilization across all the plants. So once this happens, then we have enough room to expand on a brownfield level.
Okay, so whatever expansion will come, it will be more towards the brownfield side rather than the greenfield side. Can I assume that?
Yes, absolutely.
Oh, okay. And by next year, can we say that Mumbai should be running at its full capacity utilization, given that it is a very big market in itself?
Yeah, Hazel. So 70% is peak utilization in our industry. So we are hoping to achieve that, from H2 onwards.
Okay, fair enough. So just last one question regarding your guidance on debt, on your debt front. Like how are you planning to for deleveraging and what are your any guidance on it?
Yes, we are very seriously working on reduction of working capital and increasing EBITDA per ton. So whatever capex were required, we were in the growth phase up to last year. I can say that up to this quarter, we were in the growth phase, and now onwards there are no major capex. So whatever will be the profitability as well as whatever will be the surplus coming from reduction in current assets will be used for reduction of the debt.
So we can say like at least till, but till when are you planning? Because any guidance can you give, like what are your plans? What is your target?
We are not giving any guidelines for this. Since our
Okay.
present capacity utilization will be increasing the capacity utilization, but one guideline is very clear that our debt is not going to increase.
Okay,
We are
sir.
planning
Fair
our
enough.
place, including the growth plan, in such a way that our debt is decreasing. We will see a reduction in debt after a year or like that.
Okay, sir. Fair enough. Thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Sir, just a continuation to the former participant. So what kind of land bank is available with us, and up to what level of capacity we can go brownfield?
So because we have enough land available across all our plants, all our locations, and we can comfortably go up to 1 million tons within the existing land bank.
And greenfield versus brownfield extension, what's the difference in the ROI basically, if I may ask?
So the capex in greenfield is almost 2x that of brownfield. So ROI for the enhanced and for the incremental capacity should be somewhere around 25 to 30%.
Understood, sir. Understood. That's all from my side.
Thank you.
Thanks.
A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Ronald Sioni from Sharekhan. Please go ahead.
Yes, just one question regarding value-added products. Now, with Q1, the prices had gone down. So, in terms of operational profitability, how this value-added products stands? You see downward revision in EBITDA per ton for this value-added products also?
Ronald, the thing is, basically there is no reduction in EBITDA per ton. EBITDA per ton is appearing lower because of the inventory loss that we have occurred in Q1. So across all our products, whether it is like normal products or valued products, the EBITDA per ton or the conversion rates remain the same.
Oh, so how much was the inventory loss?
Decline in steel prices in the month of May, month of June, month of July, month of August. So in last 4 months, we have seen constant reduction in steel prices, which is not appearing in the profitability.
Okay, so in terms of operational conversion, profitability remains the same. So how much the inventory losses can you quantify it during Q1 you have suffered?
It's a mix actually. It's a mix of a thing. We can't really quantify. In some of the products we are selling in advance, some of the products are sold from the stock. But a rough estimate can be in the range of 600 to 800 rupees per metric ton, the impact of reduction in the prices.
Okay. So when this prices stabilize and say if possibly they trade higher a little bit, then are this would get reversed, inventory losses would get reversed? Possibly during H2 or
oh. And when it happens, if there is a sudden reduction in the prices, so if you see in the month of May and June, there is a reduction of prices of about 12,000 to 13,000 rupees per metric ton. Otherwise, if it is 2,000, 3,000 rupees a month like that, then it do not affect generally our profit.
Okay, sir. Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one. Participants, to ask a question may press star and one now. As there are no further questions, I now hand the conference over to Mr. Vikas Singh for closing comments. Over to you.
On behalf of Phillip Capital, I would like to thank Mr. Anish Bansal and Mr. R.N. Malu to give us this opportunity to host their phone call. And over to you, Anish sir, for any closing comments.
Thank you so much, everyone, for sparing time to attend our earnings conference call. To sum it up, I would like to say that Q1 was a significant quarter and challenging one for the industry. We have seen a sharp decline in steel prices, which led to lower profitability. But having said that, the reduction in steel prices is a welcome step. This will contribute significantly towards higher volumes because of the reduction in prices of reduction in the gap of secondary steel pipes. And the affordability quotient has also gone up very high. The projects which were earlier stuck, they are also coming back. So with all these things, it is quite positive for the company for in H2 and also in the coming years. The company is is well poised to cater any kind of demand that comes from any geography or any sector. So that is all from me. Thanks once again.
Thank you. Ladies and gentlemen, on behalf of Phillip Capital India Private Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.
Thank you.